Breaking news last week, the world's oldest tour operator, Thomas Cook, entered into compulsory liquidation. As a result, 600,000 travelers were stranded worldwide, some of them even held hostage at their Tunisian hotels. Huge repatriation projects were immediately set up to bring everybody home. Meanwhile, around 21,000 jobs are at risk. Now, if we look at the stock price evolution of Thomas Cook over the past 10 years, the least you can say is that it has been a bumpy road. Stock prices dropping, reaching a historically low level after the Arab Spring in 2012, recovering sharply afterwards, reaching a peak in 2015 when the company became profitable again, but then slightly dropping again step by step over the years, reaching again very low levels recently. Now let's analyze what happened, starting by focusing on some key financial figures. If we assess the financial stability of a company, what we typically do is comparing the operating cash flows to the debt outstanding. And we thereby typically take the net debt, which is the debt amount minus all cash reserves. That amount has been piling up over the years at Thomas Cook, now reaching a level at around £1.5 billion. Next, if we look at the operating cash flow proxied by the EBITDA, we do see that has been decreasing over the last years, especially since 2018, and becoming even negative in 2019. Now, various reasons can be identified. The first and most important factor is the competition of new online disruptive players. Think of Booking.com, Airbnb, Expedia, and also the increased popularity of low-cost airlines. But it's also about internal factors, some bad choices. Think of some value-destroying acquisitions that happened. The most important was the merger with MyTravel back in 2007 that has been a disaster and still led to a $1 billion write-off this year. On top of that, there are some unfortunate circumstances, some one-off things. Think of the heat wave last year that really had a negative impact on Thomas Cook's margins, and also the Brexit that led to a decrease in consumer confidence, but also a significant drop in the pound, again putting a downward pressure on margins. Now, what can a company do in case of financial distress? Well, basically, there are three choices, all linked to the three types of cash flows a company has. First of all, we can take a look at the operating cash flows. Now, these can be boosted by changing the business model, by becoming more efficient, but that's typically something that you can only realize in the relatively long term. Second, we can look at the investment cash flows, and we can try to reduce investment spending, or even try to start divesting, selling some important things in order to pay off debt. And in that respect, in February of this year, Thomas Cook was really thinking about selling its airline division. And then finally, we can turn towards investors. We can ask money from debt holders or shareholders, or opt for a debt restructuring. And that eventually was considered. In fact, a rescue package was negotiated and agreed upon for a value of around £900 million. Half of it would be brought in by Fosun, which is the Chinese investor, the biggest investor of Thomas Cook. It also owns, for example, Club Med. And so the company, by bringing in $450 million, would get 25% of Thomas Cook's airline division and 75% of the tour operator business. The remainder of the shares would go to the debt holders that would also bring in another £450 million and would convert their existing debt into equity. That was the proposed deal, but then the main debt holders, led by RBS and Lloyds, also appointed some financial consultants to check the financial viability of this package and of the company. And these consultants decided that another $200 million was necessary to make it through winter, because that's typically a cash flow period for Thomas Cook. On top of that, we can also question the real motives of the debt holders, because many of them took insurance against default. They bought what we call credit default swaps. These credit default swaps lead to significant payouts, paying back the bonds at the moment of a default. But of course, these payments only happen at a real moment of default. So there was no real incentive for these debt holders to opt for a negotiated deal. On top of that, there were quite some hedge funds also investing in these instruments and making a lot of money. So these were definitely happy people on Sunday evening. If all of this does not work, then there is one option left, and that's turning towards the government. And so the UK government has been asked to provide another 150 to 250 million pounds, but they refused. And Boris Johnson explicitly referred to the risk of moral hazard in case of future commercial difficulties at companies. So that left a 178-year-old company no other option than to go for liquidation. Now finally, let's take a look at what is happening with other companies in the same sector. If we look at the stock market and the stock market reaction at TUI, for example, we do see that the stock price jumped on Monday morning after announcing the news immediately with 10%. And the same happens at low-cost airlines. Ryanair jumped with almost 3% and EasyJet even by 6%. So you can definitely say that one man's loss is another man's gain.